Good morning, everyone, and welcome to our first webinar for 2021, Navigating the Now. My name is Reza. I'm the National Sales Manager at PPS Investments. And joining me today from our investment team, we have our Chief Investments Officer, David Crosoer, as well as two of our portfolio managers, Luigi Marinus and Reza Hendrickse. 2020 has definitely challenged our assumptions and perspectives on investments and investing. We've witnessed the sharpest recession on record as well as the fastest ever rebound. Moving forward, we view 2021 as a potential watershed year for investors as we consider both the challenges and opportunities in equities and fixed interest, and outlining our approach to navigating this particular landscape. Please add your questions to the comment box below, and we will be sure to address them to the investment team. We do have enough time to be able to take questions at the end. We've made sure of that. Just covering our speakers today, David will talk a bit about our economic landscape, while Luigi and Reza will discuss the fixed interest and equity components. So without any further ado, I will now hand over to David to kick off our session for today. David?
Thanks, Razek, and good morning, everybody. And again, apologies also if you've been battling to get onto the webinar. I'll go a little bit quicker than I'd planned, just so that we can still finish within the allotted time. So if you move to the first slide. So this is really the challenge and the opportunity for all of us today. Can we look at the world in a different way and in a more accurate way? And what do we need to do to try to shift our perspective? And what we're going to be doing today, my colleagues and I, is going to be trying to challenge you in terms of how we need to look at various components of the world in order to better understand it. Now, when you first look at this map, you might be surprised that it is actually a more accurate depiction of the globe. The cartographers that came up with this had the innovative idea to show a map of the world on both sides of the pieces of paper. You can almost think of this as a two-play record disc. You've got side A and side B. And they also thought they'd put the poles in the middle of the globe and not on the edges. And because they did this, the distortions that normally take place on a map are minimized. And they published a paper last week on this, and it's quite an interesting read for those of you that are interested in this. For us, as an investment team, we're also wanting to look differently at the world and to challenge our thinking. And it's really inspiring that something as simple as a map, which people have been drawing for 400 years, someone could come out with today a more original way of trying to show it. I'm sure what you see in this map will resonate with you in different ways. For me, the two things that really struck me was firstly, how large the oceans are in comparison to the continents. And that's quite an important theme that we're going to speak about today, because a lot of people, when they look at financial markets, are surprised at how they're performing in relation to the real economy. And in a sense, the continents are the real economy, and the water around the continents is the liquidity that has been put into the financial system. And so I think one doesn't understand markets if one doesn't also take into account all the liquidity that's going around the world today. And maybe the second point that also struck me about this chart is just the two polar ice caps and the sense of whether they would still remain at this size going forward. And we are going to talk a little bit about climate change in the presentation, and that's certainly something that will challenge us in terms of the map or the perspective we need to take in terms of the world. So if we move to the next slide, this just how should we view what's happening in financial markets today? And this slide just vividly illustrates what's been happening. And I've used the global financial crisis as a context to the COVID crisis, and I've superimposed the performance of the global equity market in US dollars during both of these crises. And that's the chart on the right. If you look at the dark blue line, you can see what happened since mid-February last year. That's almost a year ago to the date. A very sharp fall in global markets, followed by extremely strong recovery. And although we've had some volatility in the last couple of weeks, it's barely noticeable on this chart. And if you compare this to what happened in the global financial crisis, and again, I've just taken the peak of the equity market in mid-October 2007, you can see that markets fell further, but not as sharply downwards, and then took a lot longer to recover. On the bottom, we're just showing the days from the prior peak, and you can see that markets took almost more than 5 times as long to get to the levels that they've already got to today. So what accounts for this rapid rise in equity markets? Well, a clue is shown by the chart from The Economist on the left. This just shows you this fiscal stimulus that governments have put into the global economy. And it compares what happened in 2008, 2009 to 2020. And you can see that the response in 2020 dwarfs anything governments did in 2008 and 9. In a sense, they've learned the lessons from 2008 and come in much more aggressively. If we look at the various shades of color on that chart, what also is interesting is the relative response of China, which is the dark red line. And you can see that China has aggressively invested in infrastructure spend in 2020, and you can see that on the bar there, but also the response of other countries. And the one that maybe is most striking is the US. That's the lighter blue on the far right. And that response has been significantly greater than China. So the United States has done a very large fiscal response. It's the economy that's had the greatest upward revisions to its growth forecast for next year. And it's a market that many managers have been underweight for a very long time because they view it as expensive. And my colleague Reza is going to comment a bit about developed versus emerging markets, etc. But it's quite interesting to see how strong the developed market fiscal response has been. And if you look for the emerging market response, you can see that compared to 2008-9, emerging economies outside of China have not really been in a position to do a big fiscal response. They simply can't afford it. Is this the whole story, though? If we move to the next chart, I thought I'd again now focus on the real economy rather than the equity market. This just shows the global economic growth of the global economy, and I'm looking at 2008. It's again in the dark blue compared to 2020, which is the grey bars. Now the two lines in the middle of the chart show what happened in 2008 and in 2020, and I think this is self-evident to all of us. The contraction of the global economy in 2020, which is now expected to be about -3.5%, is significantly larger than the contraction that took place during the global financial crisis of 2008, which the economy did contract by a far less amount. The other point this chart makes, which I think is also obvious to most of us, is that in the preceding 5 years, building up to the crisis, global growth has been far weaker today than it was in the build-up to the global financial crisis. So those bars before the crash just depict how the global economy grew in the 5 years leading up to the respective crashes. And you can see in the dark blue lines that global growth has been scarce. And Reza is going to talk about how companies focusing on growth have outperformed in this environment, given the scarcity of growth. But the third perspective this chart brings, and this one surprised me when I built the chart, is just the projected growth post these two crises. So the grey bars to the right reflect how the global economy grew from 2009. And the striped bars reflect the IMF's projections about how the global economy will grow going forward. And why this was surprising to me is if you look at this chart, you can see that the global economy is not expected to grow that much stronger than it did coming out of the global financial crisis. Now, given all the stimulus that's taken place and given the very negative base effect of 2020, one would have possibly expected a greater growth rate. And this just these expectations could, of course, be wrong. I mean, typically forecasters are behind the curve, and the IMF could well raise its expectations going forward. But when we do think about whether there's a rotation into more cyclical shares or how aggressively we should move the portfolio, it is worth just comparing it to how the economy grew in the past. It's not necessarily as robust a recovery as we might have thought. Clearly, it's expected to grow more than it grew in the prior years to the COVID crash, but it's not growing anything more rigorously than it did prior to the 2008 financial crisis. So that's a clue to the map, which is quite interesting. And if we just look at another clue, if we move on to the next slide. What is different then? If the global economy is not really growing at a greater rate, why are markets reacting so sharply? And really the US 10-year bond yield, I think, is the crucial piece in the puzzle. And we've had a map of the US 10-year bond yield for the last 30 years, which has basically shown this yield has been declining consistently through time. And more importantly, today compared to 2008, the US 10-year bond yield is significantly lower. And the reason the US 10-year bond yield is so important it is effectively the risk-free rate that all other asset classes are priced off. And you can see that in global financial crisis and quite long after that, it was around 4.5%, and it's now significantly below 2%. So this low global interest rate has caused a lot of asset classes to react very strongly. And the really big question that we should be asking ourselves is, to what extent is this 10-year discount rate going to remain low, and to what extent could it start to retrace its steps? Now, global central bankers and the US Fed in particular are doing all they can to keep this interest rate low, and they've intervened with quantitative easing to keep it low. But is there a chance that it might retrace it more towards the 2008 level? Because if it does do that, then the global growth that we're expecting doesn't look that attractive in relation to what's happened in the past. And so if we move to the next slide, this is really the critical question. Okay, so that title's not correct, but just this is dealing with the credibility of the central bank. And the critical question here is, are central banks remaining in control of inflation? So if you look below, you'll see that global inflation has been contained for the past 30 years. The red line is the US, and you can see that unlike in the 1970s, where it was out of control, it's steadily fallen to manageable levels. And central banks have been able to keep interest rates low because global inflation hasn't come out of control. Now, all central banks want some global inflation. It's necessary to help reduce the global debt burden, but they don't want a situation like the 1970s where they will be forced to raise interest rates. Now, that cartoon on the left is obviously tongue-in-cheek. The level of interest rates of the US Federal Reserve is not set by the height of the chairperson of the Federal Reserve, but it is pointing out in terms of the newest addition to the Fed, Jerome Powell, what is he likely to do? And he's signaled very much that he wants to keep interest rates low for as long as possible. So unless one believes that the US Fed is going to lose credibility and be forced to raise interest rates, it looks like this benign environment of very low interest rates could last for longer than we think. And with that, let's go to the next slide. I thought I should just also frame South African economic growth in perspective here. How should we look at South Africa? What should we think about? And this chart is constructed in the same way as the previous chart. In other words, in the middle, that's how the South African economy contracted in 2008 and in 2020. And you see we expected now to have contracted by -7.5%. That's a lot better than the -10% I feared we would have contracted, but clearly significantly worse than what we did in 2008. Again, if we look to the left of that line, you can see what everyone knows. Our growth in the build-up to the COVID crisis was anemic compared to how we grew during the last commodity super cycle. And that explains why we entered this crisis in such a weak position. But more troubling, if you look on the right, you can see that the expectation for how our economy is going to grow out of this crisis is not stronger than how we grew out of the global financial crisis. So again, forecasters could be wrong about this, and we could surprise on the upside. And certainly a number of managers are thinking South African growth could surprise on the upside. But at the moment, although our growth rate is expected to be better than it was leading up to COVID, it doesn't look great in terms of what we were able to achieve in the past. But the place where our map is likely to be the least accurate is the next slide. And that is just how are we going to transition to a global economy? And this cartoon is from the Financial Times of earlier this year. And I think the response of CEOs to dealing with climate change by some symbolic gesture is long past. And there's at least two reasons for us to think that this trend is accelerating quite rapidly. The first is shown on that diagram below, and South Africa's in the middle. And this is just retail investors' interest in ESG funds and ESG products. And you can see that 2 years ago, South Africans weren't interested at all in ESG products. That interest has increased significantly over the past 2 years, and that applies almost everywhere across the world. And the second important shift is we're starting to get more reliable data about the impact of climate resilience on companies' earnings per share growth, on their stock price. MSCI released a paper earlier this month that did a detailed exploration of this, looking at did companies do better that were better managing their ESG risk. And the study is available online if you're interested in it. But two of the things that were very interesting was that controlling for sectors, companies with lower carbon intensities typically have been doing better. And when you look at regions, the developed world outside the US has definitely been doing better, companies that are managing these risks. The US has also started to do better. Initially with Donald Trump, it did worse, but it is starting to reward more companies that look after this. But emerging markets are not yet pricing this in. So the study found no relationship between better climate mitigation strategies in emerging markets, but the trend was very much entrenched in ex-US global companies. And I suppose the question we should ask as South Africans is this trend likely to accelerate to emerging markets too, as the globe tries to transition to a world that doesn't heat up by more than 2 degrees centigrade? And we think it's likely to do. So a lot of the debate currently is around emerging markets and whether one should be overweight emerging markets. We think one needs to look also through the lens of climate change and the vulnerability of some of these emerging market companies to this particular issue. As a multi-manager, we are engaging regularly with our managers in terms of how they're thinking about climate change. It is not a straightforward topic, and possibly we'll have some questions afterwards. But I think we do need to realize as South Africans is that we're in a very much carbon constrained economy. Our economy is very much dependent on fossil fuels and carbon emissions. And consequently, from our perspective, global managers that we use that are thinking about climate change can offer us quite interesting ways of diversifying the South African specific risk. And so we are looking to our global managers to try to lead us in terms of how we think about that. The climate change might be the long-term problem facing us all. The more immediate problem, I think, for South African investors is how to get a real return out of fixed interest assets. And with that setup, I'm going to hand over to my colleague Luigi, who's going to deal with this and other challenges facing us today.
Thank you, David. Morning, everyone. Thanks for joining us this morning. As David referred to earlier, we're talking about new perspectives, and I think that's something that I would like to introduce when I refer to or talk about cash, and I hope I can keep it interesting enough. Thank you, Salma. You can go to the first slide. So somewhat busy slide, but I'll just go through it very quickly. We've got 4 lines and a couple of bar charts at the bottom. And we look at the gray line at the top. That is a Steffi 3-month, so that's the return we get from cash in the market, and the blue line is the repo rate. The repo rate is effectively the rate that the Monetary Policy Committee of the Reserve Bank keeps on the rate, and they decide when that's going to increase or decrease. I think the first point to make is that we can see that cash yields follow that repo rate very closely, and that's because that's how the rate that cash yields are priced off of. Then the blue line that's a bit more squiggly in the middle, that's inflation, and we know inflation quite well, and we can see how inflation has declined over the last few years. The last time inflation was above the top end of the target band was actually in 2017, and since then inflation has moderated quite a bit and has been well maintained within the target band. I think the important part of this slide, though, are definitely the purple lines or the bar charts. And that shows us the repo rate minus inflation. So effectively, it's what investors can earn and what your clients can earn if they invest in cash, but the amount they earn above in inflation. If you look back on the purple lines, we can see that for quite a long time, in 2017, 2018, for much of a large part of 2019 as well, clients earned 2% to 2.5%, almost 3% at some points above inflation just by holding cash. And the advantage of that is that cash has a very low volatility. You know, when you invest in money market funds, for example, it kind of edges up a little bit at a time, so you kind of get very low volatility for that cash return. What we can see quite clearly from the purple lines, though, in the most recent 6 months or so, is that yield above inflation has declined significantly. And that's as the Reserve Bank has reduced interest rates and the repo rate has come down to 3.5%. Now, cash rates are only about 0.25% to 0.5% above inflation. And the question is that a sustainable level of yield that clients can earn over this time? Or are there any other options? And if we click to the next slide, please, we can see that Clear from the title, we prefer bonds, and so this is the opportunity that we think that is available in the fixed interest space. We understand that cash has a very low volatility, and even though you know the coupon that you're going to earn on the bond at the time that you purchase a bond, bonds are still sensitive to interest rate movements, and so there is some volatility with bonds. But what this chart shows, it shows the difference between the yield you can earn on a bond compared to the yield that you're earning on cash. And the most recent point you can see is at 4%. So that means that bonds at the 10-year level, so if you're buying a 10-year bond, you're earning 4% more than what you'd earn from holding cash as an investor. In addition to that, if you look at the more recent peak, you'll see that that was above 5.5%. And that was at the time when COVID-19 just came into the economy and the first talks of lockdown occurred. And there was a lot of uncertainty, especially around emerging markets. We saw that bond yields spiked, and that was a good opportunity for investors to buy bonds. And we definitely increased our bond exposure within our portfolios. Even as that bond yields came down, we still think that a 4% level above inflation is still quite a good opportunity. We often hear, I think, what people refer to as a steep yield curve. And by steep, we mean that the short end, so where cash is, that's very low, and the long end, where bond is, that's very high. What this chart also shows is that such a steep bond yield is normally not sustainable for a long period of time. On the two occasions that it did happen or reach these levels in the past, eventually it did come down quite significantly from that point. And the way that the steepness of a bond yield declines is that at the short end, where cash is, either that cash rates go up, or at the long end, where bond yields are, those bond yields come down. So let's look at that two possibilities. Let's think about cash. When does cash yields go up? Or when does the repo rate go up? And that's when the Reserve Bank, or the Monetary Policy Committee, decides that they need to increase rates, normally on the back of inflation. So we have to ask ourselves, do we think that inflation is a concern in the South African market? And I think there's nothing at the moment, even on the day where we know petrol prices are increasing today, and we know that Eskom has been a 16% increase has been approved for Eskom. We still don't see enough of an inflation push within the economy to be too concerned about inflation in the short to medium term. So in terms of the yield curve, we're not too concerned about short-term rates increasing at this point. What we can see the possibility of, though, is that the long-term yields or the bond yields comes down. And we know from Finance 101, when bond yields come down, the price of the bonds increase. And so on the next slide, I'll talk a little bit about the budget and the implications of the budget on bonds in particular. I'm sure everybody's read quite a bit about the budget in the last few days. I'm not going to go into too much detail. This cartoon was actually drawn in 2020 by Zapiro, but I thought it's still relevant for 2021, as I think Tito is still needing to juggle quite a few balls in terms of the budget. For us, though, and in terms of what it means for bonds, there were two main points within the budget. The first point was that there is a definite increase in the issuance of inflation-linked bonds, and we're quite keen on inflation-linked bonds, and maybe in question time we can answer more questions around inflation-linked bonds. I think we'll take a bit too much time to go into too much detail on that. But the budget showed that there will be, of the government issuance, 25% will be in inflation-linked bonds. And the second part of it was the Treasury's realization of the level of yield that we are paying at the long end of the yield curve. So the longer maturity that the bond has, so say the government's issuing a 15-year bond, for example, and the yield they need to pay on that bond is between 10 and 11%. That's quite a significant yield that they need to pay every year to investors, and that servicing that debt is quite constraining on the fiscus as well. So the plan is to shorten those maturities, and instead of issuing 15-year bonds, or for the most part, rather issue 5-year bonds, and then rather pay a lower interest rate on that, because the coupon or the yield on a 5-year bond is closer to 8%, and so that debt burden can decline as well over time. And so if you are a holder of bonds in the long end, that supply constraint has declined, and if there's any demand there, that's likely to moderate the bond yields or decrease bond yields. And again, if those bond yields decrease, we think there's a good opportunity that the bond prices will increase and it can be beneficial for investors as well. Of course, this is not a risk-free investment in the same way as we consider cash to be. And often we have the question about defaults. What's the possibility of a default? We can't say that there's a zero possibility. That's never the case. There's always some risk when debt's involved, but that's not something that we are too concerned about. If we think of other examples in other countries, Argentina, Turkey being good examples, when they did reach a default level, it was because they had a high proportion of foreign debt. And what happens when you have foreign debt is that often your country comes under difficulty, your currency depreciates, and that debt just balloons because you are unable to pay in the strong currency. As South Africans, or our treasury has a very small foreign debt exposure, and so we're not in that, we don't have that same concerns. Of course, it does not mean that bond yields cannot increase, but that's a risk that we are aware of. We still think that the right fundamentals are in place for that yields to be more likely to decline than increase. And even if rates stay where they are, at the long end, that there is sufficient compensation just by getting that yield alone without any capital movement in the bonds. And then my final slide, I think, kind of talks to something that David spoke to already. So David showed that the 10-year US bond, how long, a long-term chart of that. He showed it from 1970, and we saw that yield peaked at about 17% in the late 70s and early 80s. And I've just shown the last 1 year of that chart. So this is what the markets has been a bit jittery on. And I think that cartoon kind of spells it out quite well. The 10-year treasury is sensitive, but investors are also sensitive about the movement of the 10-year of the US 10-year bond as well. So I don't want to downplay the importance of the 10-year bond. It does count as kind of the base pricing asset across the world, and it's a very important number. But you can see from the levels that we were at, we're not saying that a bear market in the US 10-year bond is imminent. Recently or last week, it just touched 1.5%, so that's a 1.5% yield per annum for 10 years, which we wouldn't say is at exceptionally large levels. But it is something that needs to be watched quite closely. In addition to that, if we compare the South African 10-year bond, we still can earn a significant yield above this 1.5% that is on offer in the US. So I think I'll close with that, and just to kind of reiterate again, cash has been a fairly easy investment over the last, let's say, a year to 18 months ago. But that opportunity, that high yielding above inflation opportunity, is no longer on the table. The decline in interest rates by the Reserve Bank has meant that clients have to, or unfortunately faced with the decision that either you accept a lower cash yield with a low volatility, we talked in the region of 3.5% to 4.5% from cash, or you take on some risk within the portfolios and invest in some bonds, nominal bonds and inflation-linked bonds. And that's the direction that we've taken within our portfolios. We understand that there is some risk involved, a bit more risk in bonds than cash, but we think from a risk-adjusted perspective, the additional yield that you can earn on the bonds is worthwhile for that slight additional risk that you are taking. And with that, I'll turn to Reza to speak about equities.
Thanks, Luigi. And good morning all. Thanks for joining us here today as we try and make sense of the world as it is, and or rather navigating the now, as we've put it. So David has set the scene from an economic perspective. Luigi then gave us some fixed interest insights, and so now I'll be taking us through a bit of an equity perspective. On my first slide, yes, over there, up there is a question I think, or I'm sure has been on the mind, in the back of many of your minds, because markets have certainly run hard. The JSE is up about 30% over the past year, and around twice that since the depths of the COVID sell-off. But the market has only just broken out to new highs, and that trend might only just be getting started. But regardless though, Given the strong move higher, I think it's natural to ask whether one might have missed the boat, like that unfortunate gentleman on the dock over there. And the short answer to the question is no, it's not too late to get in. It's never too late to get in, provided, of course, you have time on your side. And that is the key thing. One does need time in order to be able to live through that full cycle. If you don't have time, then equity is probably not the right thing for you. For those that do have the luxury of time, though, then over the long term, as you can see, you will have been quite well rewarded in equities. And this chart goes back all the way to the 1960s. You can hardly notice that COVID sell-off, just like the many others that we've seen before. So if it's never too late to get in, then why is it that people are so obsessed with timing their entry so perfectly? And the answer obviously is because nobody wants to buy right before an untimely sell-off, even though those are nearly impossible to predict. That fear is actually so compelling that it's quite easy to become that traveler over there on the dock. But the main reason people worry about being early or late is generally that they're taking too short a view, and often because they haven't left themselves enough time to stay in the market. So it's often said that 5 to 7 years is a reasonable time horizon to be able to stay in the equity market. But in reality, even that is sometimes too short. And so even South African equity, I think, is a good example of that over the past few years. And so the best advice I can offer you is actually what you already know, and that is to stay committed and not to make frequent and drastic changes to your exposure by going completely in and out of the market at potentially the wrong time, because that is what ultimately ends up being value destructive. If you do that, you have to perfectly time both the sale and the re-entry, and those are two very difficult decisions that one needs to get right. But we'll come back to asset allocation towards the end of the presentation. So on the next slide, yes, another topic that's probably on your mind when you think about equity is whether the winners of previous years will continue to lead the way, or whether we're on the cusp of some sort of rotation into previously unloved parts of the market. As we all know, global equity returns over the past few years have been dominated by some key themes, for example, the outperformance of developed over emerging markets, and the US in particular, and another example being the outperformance of growth versus value, as David mentioned. The key drivers here have been the dollar and the long bond yield, which post the GFC stimulus has distorted by compressing developed market bond yields. Tackling growth versus value, which you can see in the chart, where growth shares have massively outperformed value in recent years. This hasn't always been the case though, and we can see that these are actually cycles which do tend to play out, where in the early 2000s, for example, value actually outperformed growth. But the question today is that given this big gap that's opened up on the right, are we heading for a situation in the cartoon where the investor and his advisor, where his growth stocks are now on course to get crushed as the market rotates into value? So this is of course possible, and it's in fact inevitable at some point, just given that cyclicality of the relationship. But our view is that it's too soon to tell for sure whether we're at that inflection point right now, or whether this is a false start perhaps, like the many others that we've seen in recent years. What we do know though is that when the cycle does turn, it will be quite an enduring move. So there's no need to be early. And we think the US long bond yield rising sharply will be a key thing to monitor in this respect, because that value growth ratio is very much driven by the US long bond yield. And the reason for that is that growth stocks are seen as long duration assets, where most of the cash flows are expected to come far into the future. And so perhaps another topic on the rotation front could be that potential switch in outperformance of developed versus emerging market equity. But the dynamics there are very similar, given that the growth and tech are just such big drivers of US equity. So in short, maybe we are in the early stages of some sort of rotation, and we do appreciate the fundamental argument in favor of a rotation, but for now the long-term trend still currently favors developed over emerging markets as well as growth over value. But let's shift gears a little. I've given you a sense for the importance of staying invested in equity for the long term, and also I've touched on a few, some of the shifting sands rather, in terms of where the opportunities within equity could lie. But I'm now going to focus on our two important access points into equity, being PPS Equity as well as our partner Capital Group via PPS Global Equity on the next slide. These strategies were both strong contributors to performance last year, and it looks like this year, once again, we could be setting up for another rewarding year if the backdrop for risk assets actually does in fact prove to remain supportive. So here we have PPS Equity, which I'd like to remind you is a domestic only fund. The fund has done well over time, as you can see, having beaten the market over these periods, thanks particularly to a strong 2020. So we're positioned first and second quartile over pretty much all periods, despite holding no offshore, as I've mentioned earlier, which some peers do. As you know, Fairtree made a strong contribution here last year with their 9% alpha, and with resources being quite key to that. But Truffle, which was introduced in the portfolio last year, as well as 91, which has been in the portfolio for several years, are both equally impressive in terms of potential. And so the mix of managers here really is competitively placed and very well positioned to compete locally, we think. Our market, as you know, is a tricky one at the best of times, being quite narrow, so there isn't really a massive amount of choice in terms of viable stocks to choose from. And so in turn, returns often get driven by a very concentrated group of shares, and you can think Naspers, resources or banks, etc. We're also an emerging market, and so one tends to find that global macro forces tend to have quite a meaningful impact on our market. So we think we're approaching SA equity the right way by investing in a blend of established and boutique managers that are both active as well as, for the most part, style agnostic. The managers are also very good practitioners of both bottom-up as well as top-down, with a high-performance culture and a competitiveness that I think one needs in order to be able to stand out from the crowd. Turning to my last slide, and speaking of standing out from the crowd, this is our global equity partner Capital Group, which beat the market by around 20% last year, close to 20, and has an equally strong long-term track record. So despite being a very large organization, they're actually quite unique by being pioneers on many fronts, including their seminal work in constructing the MSCI global indices, as well as perfecting, we think, the multi-council approach which they follow. They've probably been amongst the most successful globally in terms of applying that framework. So there's 7 multi-councillors that run the new perspective strategy, which is what PPS Global Equity buys into. And each multi-councillor manager follows their own unique approach, with Capital then providing a very supportive environment for them to excel. And the end result is a very dependable return profile that's been outstanding over the long term. And this strategy has actually been around since the 1970s, and that's 48 years, which is 8 years longer than I've been around. It was my birthday yesterday, just by the way. So here's a chart of the MSCI ACWI, with the shaded areas highlighting some key bull and bear periods. The purple and blue numbers during those periods show you what the new perspective strategy performance was during those up and down markets. And as you can see, they've almost always beaten the market, whether it's in an up or down phase. And the table really highlights that even over shorter rolling 3-year periods, there's been a very high level of consistency, with them having beaten the markets 100% of the time in down markets and 88% of the time in up markets, which is quite incredible. I could show you a similar chart of how they've done equally well, regardless of whether value or growth has been experiencing a style tailwind. The bottom line, though, is that this strategy has been able to outperform irrespective of market cycle. And this long history of outperformance over numerous regimes and the very strong qualitative case for the manager with their business team and strategy all proving very favorable gives us a great deal of confidence. And so by and large, we're really not concerned about trying to time any rotation of any sort. And instead, we're focused on just having the right managers in place, both locally as well as abroad, which we believe we do. And this should allow clients to remain well placed to participate in whatever opportunities the market might actually present. And with that, I'll end off and hand back to Luigi just to make a couple of comments on positioning. Thanks very much.
There's just 2 more slides that I want to chat to, and the first one is the next one, which shows our house view. And our house view is effectively the asset allocation calls that we have in our portfolio. Quite clearly, there's a green arrow, which means that the allocation has increased at that meeting, and a red arrow down means that the allocation has decreased in that asset class in the meeting. I think the first thing that maybe stands out is that during 2020, we've actually made quite a few more asset allocation changes, probably more than what we've made over the last 3 years. And I think it's not that we're that keen to make changes, or we think all these changes are always necessary. 2020 was a somewhat different year, and often volatility within markets gives you an opportunity to take advantage of those maybe mispricings or kind of skewed prices in certain asset classes. We generally want to move the asset classes in the same direction. So if we increase them, we continue to increase and not necessarily make multiple changes in opposite directions over short periods. And having said that, I think you can see with SA equities, we decided in the first quarter of 2020 to downweight the equity allocation. Arguably, in hindsight, we can say that was maybe a tentative move. At the time, we were concerned about the lockdown or the implications of lockdown. We were quite negative about the possibility of vaccines coming to the market quite early, and we thought that it's very likely that we'd have a lockdown for much longer than what was initially thought. So even though we had a lockdown for longer than what was initially thought, the ability to get vaccines that were effective into the market quite quickly definitely surprised on the upside, and that had a very positive effect on the market. That kind of came to fruition in the last quarter of the year, and when we saw that vaccine efficacy had improved and the availability had increased as well, we decided to go back to neutral allocation, and from that point that has actually been beneficial for our portfolios. If we look at SA property on the other hand, prior to 2020 we decided to decrease the domestic property allocation to a max underweight across all our portfolios. That was definitely not because we saw COVID coming in 2020. It was more a fundamental view on the property market. We saw evidence that rentals were coming under difficulty. The ability of property companies to be able to pay dividends to clients was also coming into question, and we just thought that the fundamentals for property were very difficult. We've maintained that max underweight. We know in the last quarter property had a bit of a bounce, but we just think from a risk-adjusted perspective, the other asset classes over the long term still offers more surety than what we can get from the property market. So we haven't changed that perspective on property yet. SA bonds, which I've spoken about, and which I showed in one of the charts, when we saw bond yields spike at the initial discussion of lockdown across the world, we decided to try to take advantage of that, which we did, and we moved to a maximum overweight allocation in SA bonds. That has played out quite well. Of course, the bond market did have some volatility last year. It was quite negative at the beginning of the year, but thereafter it worked out quite well. Bonds actually ended 2020 nominal bonds at about 8.5% return, which dwarfed the SA capped SWIX index, which only returned 0.5% last year. And cash, no surprise here that we went to a max underweight in cash as yields consistently declined, or the repo rate declined, short-term yields declined as well. And we just think that what we're getting from cash, or which is earned very slightly above inflation, does not compensate enough for holding too much of that asset class. We'll rather choose to have bonds and other asset classes rather than having cash. International equity, for the same reason that we increased the domestic equity to a large part, and the rolling out of vaccines and the positive news from a COVID perspective also had a positive effect on the international equity market. We did, however, see last year, somewhat of a surprise though, was that the rand strengthened significantly against the dollar. In the last quarter, we actually saw a 12% increase in the rand relative to the dollar. So even though the international equities were provided a very strong return in dollars, that did not translate to a large return in rand because of the strength of the rand. We do, however, still think that international equities offers a vast amount of opportunities, quite a bit more opportunities than we see in the South African market. And the international managers that we do invest with, as Reza spoke about, the one was capital, but also we tend to have global managers that have access to vast areas of different sectors than what we are capable of investing in South Africa. Other than that, we didn't make any changes to international property, international bonds, or international cash. And then I think, of course, the million-dollar question is, well, how is this translated to performance. And that's the final slide we have before we open up for to some questions. And these are our portfolios. At the top off, we have our multi-managers and our fund of funds. And then at the bottom, we have our partnership range. And we can see for the most part, the decisions that we've made have led to strong performance by our funds, especially over the longer term. All our funds are either, we look at 3 years out, in the first or second quartile. Here and there's one that's not flexible income, maybe the one example. Over 5 years and more, all other funds have given quite a strong performance. So that's a combination of asset allocation, so making asset allocation calls when we think it's appropriate to do that, and strong manager selection as well. We take a lot of effort to make sure that we understand the managers that we invest with. We meet them regularly, understand how their teams are performing, how they're thinking about the market, and what that means for our portfolios. And I think I'll end there. Thank you.
Thanks so much, Luigi. Firstly, just on behalf of everybody, I'd just like to say thanks to David, Reza, and Luigi for the insights. The performance of the funds clearly show that you have done great work with manager selection and asset allocation. And I'm sure that our investors have definitely benefited from that great work. So kudos to you guys. We really appreciate your effort and time.